Welcome back. You're still tuned into Trading Hour on CNBC TV18, and let's talk about the markets and invite our guest on the show, Ashutosh Bhargava, who's fund manager and head of equity research at Nippon India Mutual Fund, joins us now to take some questions. Ashutosh, good morning. Thanks a lot for joining us. I'm going to get straight into the sectors and stocks that you like. So if you can take us through, if in the past few months, has there been any big change that you've put into play in terms of sector allocation?
Not really. So we have been overweight on cyclical sectors, so banks, industrials, and consumer discretionary in general. We have reduced some bit of our overweight in these sectors, but not materially. Overall construct remains same, that we are cyclically biased in most of our portfolios and positioned more towards domestic demand-oriented stories. And despite some of the recovery in global demand-oriented or global pricing-oriented sectors in recent days, we still think that there are more downside risks to those segments. So pretty much focused on domestic demand-driven cyclical sectors.
Ashutosh, we have never made a high when the rest of the global markets have been in a turmoil. The last couple of times, whenever the markets went to all-time high levels, the rest of the global markets were also at all-time high levels. It was a global synchronized move. This time, it's vastly different. So the question is, can Indian markets continue to stay at all-time high levels while the rest of the markets continue to languish, or do you see a catch-up taking place? We stay where we are, consolidate, but the rest of the global markets catch up and outperform us.
To be honest, when we think of local market or even global markets, what we are very sure about is that any further up move in the market has to be driven by earnings and not multiple expansion. We don't think there is a case for multiple expansion in most market, barring one or two markets like China, etc. In our market, I think the best phase of outperformance versus other market is probably behind. The only good part for our market is that when we think of earning risk, we find a lot of risk to global earnings. But the kind of construct that we have for our market, I think the earning risk is much lesser in our market versus many other markets. So earning would be the focus. Multiple expansion is broadly unlikely. And in that sense, India perhaps would perform in line with most of the markets and not underperform despite a very sharp outperformance over the last 1.5 years.
Right. Just looking at a bunch of the names that are doing extremely well, the valuations out there are also at a record high. Not only are the stocks at a record high. So how much more upside do you see even if we were to, maintain our outperformance as against the world?
So if we do more of a bottom-up kind of, assessment and say for Nifty 50, looking at the target prices, the implied return for Nifty would come at around 13-14% 1 year's time. And that looks reasonable. Obviously, it will be along with a lot of volatility, but that looks reasonable. There is no clear-cut one or two big sectors where you can expect 25% or above kind of gains. That doesn't look the case. But in different sectors, we find between 5 to 15% kind of upside at a sectoral level. And that should be the kind of return expectation from here on, low teens kind of return expectation that we have. And as I said, it would be very much similar to the earnings growth that we are penciling in for, say, next 12 months, around 16-17% growth over the next 12 months. So pretty much in line with that.
All right. Session with Ashutosh Bhargava of Nippon India Mutual Fund. Ashutosh, we have a list of your top holdings: ICICI Bank, HDFC, Infosys, Reliance, Axis Bank, etc. But if you could tell us, are there any stocks which are not in your portfolio but you are evaluating right now? So could you give us some indication of where do you think value may lie?
So I think rather than taking individual names, I think there is definitely a case to look at, say, some of the sectors like cement, etc., or some of the staples names also where we had large underweight. So those are the segments where there could be some margin support coming in the near term. So this is where perhaps we would like to reduce our underweights. But other sectors like tech, etc., where we have slight underweight, we perhaps would look to wait for some time before we perhaps reduce our underweight, because we still think there is a possibility of earnings downward revisions in those sectors, and maybe going into the next earnings season, when the global corporates announce their tech budgets, etc., we might get an opportunity to reduce our underweight in that segment.
All right, Ashutosh, thank you for joining in. Always a pleasure speaking with you. Not looking too bad for the market. The Nifty, while it's mildly off highs, is still sitting with gains of almost 66, 67 odd percent. The mid caps are definitely flying, and how they've moved to the high point of trade even as the market meanders around that record high levels. The mid cap index now about 1% away from its all-time high. With that, we wrap up on this edition of Trading Hour. Stay tuned. Halftime report comes up next.